Welcome to Market Movers, where we identify market-moving headlines and discuss ways to either hedge risk or create exposure in affected assets. We have Scott Martin.
Hi, Jim.
Scott, so, the biggest headline this week, we have jobs data, we have pandemic uncertainty, and we have the Fed. What are you looking at?
Well, all three of those are very important, Jim, and they're each kind of in their own space. The jobs data as relates to improving economic data, the jobs numbers, certainly we continue that narrative. The pandemic uncertainty is real with some of the cases that we've seen resurging. And then I think the elephant in the room, though, Jim, continues to be the Federal Reserve, and any weak data or, say, any uncertainty that's out there leads the Fed to continue to stimulate.
Okay, tech's been ripping ahead of everything else, and it doesn't seem to matter if the market's focusing on a recovery, a post-pandemic recovery, or a new world that involves the pandemic. Is that going to continue?
I do. And we've been nailing that on Market Movers for several weeks now. And it's for two reasons. One, because the NASDAQ has been the leader. If you just look at some of these market rallies over the last couple months, the NASDAQ has led us there. And then secondarily, and maybe most importantly from a backdrop standpoint, these are very well-heeled companies, very strong revenue growth, very strong net profit pictures for these companies that are in the NQs, and very strong balance sheets. So when I look to these rallies, I always look to see what the NASDAQ NQs are doing to see if they're real.
So CME offers NASDAQ, Dow, S&P, Russell, both the minis, the micros, and liquid options contract expiries on Fridays and monthlies. Onto the dollar, Scott. Yesterday, the dollar creeped up above 97.80, was rejected, and has been trading weaker since. Gold and silver got a bid because of that. Do you expect that to continue?
I do. It looks like the dollar is possibly finding some footing here, Jim. I do watch the GCs very closely, GC contracts as a trader, as an investor, because the GC is nice to me in my portfolio because of the fact that it doesn't act like S&P, so it doesn't act like the ES contract, and it doesn't act like bonds, so it doesn't act like the ZN contract either. It's kind of one in its own vehicle. So when I add GC to my portfolio or add gold in there, I'm looking to do that because of the fact that it's a unique asset class.
I like it. I'm long silver through options. The CME has the big contract in both gold and silver. They have the micros, and they have weekly and monthly options in both. Onto the 10-year. We see the jobs data tomorrow. 10-year seems to be stuck between 0.6 and 0.7%. Is there a good enough number tomorrow that could shake that out and force 10-year yields higher?
Well, the better the number, the better the chance, I believe, that the curve continues or re-steepens. And so as the job numbers come out stronger than expected, as they did last month, let's just say if that occurs, that will likely give credence to the argument of a steepening yield curve, which I believe is what the Fed wants ultimately. And so therefore, I would watch the ZNs as a reaction point to those numbers.
Back to equities for a second. Keep an eye out for micro options being launched on the S&P and NASDAQ coming in the fall. Thank you for joining us on Market Movers, where we are helping to make you a better trader.